Hello, everyone, and welcome to Introduction to Financial Accounting. Now, two disclosures before I start. One, if you're using this as a supplement to a class you're in, just be aware. I say this isn't your dad's accounting class. And what I mean by that is, I'm not going to use heavy debit and credit terminology. Near the end of this video, and as time goes on, I'll talk about it more, but I will not start off using debit and credit terminology. I'll start off using the accounting equation. Now, if you don't know what any of that means, don't worry, I'm going to eventually explain both, but if you're using this for a class, just be aware of that. Also, this is not a tax tutorial, so if you're here to learn how to fill out 1040s better, not for you. So, now that I have the two disclosures out of the way, let's start it. Now, with financial accounting, it's all about relaying information about businesses. So before we get into the nitty-gritty accounting, I just want to have a plain and simple, this is what a business is, this is what it does, just broad overview. So first thing, a business exists to make profit. Now, that may sound cold to some people, but some people may say, oh, well, making sales or adding value or all these nebulous things or good customer relations. But at the end of the day, the one thing a business exists to do is make profit. And in accounting, we define profit as net income, which is all revenues minus all expenses. Now, I put all in quotations just because as we get into advanced topics that we probably won't get into in this tutorial set, just be aware that there are some types of gains and losses that are not included in net income. But for the purposes of this tutorial, we're just going to say net income means all revenues minus all expenses, and that is the sole purpose of a business. Now, don't get me wrong, businesses can understand the only way we're going to make a profit is if people choose to buy us, and people aren't going to choose to buy our products or services or what have you, unless we do things like have good customer relationship, etc., etc. But again, just the better way to think about it, and the true way to think about it is a business exists to make profit. And I put a little caveat in there, sufficient cash flows as well. Something I'll get into later is revenues and expenses are not always the same in accounting as when the cash is flowing. So we don't always say we made sales when we receive cash for it. This is a topic I'll get into later, but so I'm just adding the caveat now. Cash is king. You can't run a business without cash. So I'm just going to make a little extra snippet at the end of the definition. Make a sufficient profit with sufficient cash flows. And sufficient just means I want to put in a little thing about thinking about long-term sustainability. You can sacrifice a lot to make a good one-year profit. But in the long term, you're not going to have good profit if you sacrifice too much. And sufficient cash flows, I just put that in there because you don't want to have huge amounts of cash laying around because you should be using that to invest it back in the business. So, that's just the two little things I wanted to add about that. Now, speaking of cash, capital. Now, in the accounting, we call capital any resources to start and run a business. It could be cash, it could be equipment, it could be buildings, etc. Capital, the way finance people talk about it and the way a lot of other people talk about it, sometimes means just cash. So I just want you to be aware that those two different definitions, I'll sort of use the accounting definition of just general resources to start and run a business. Now moving on to types of businesses, we can classify businesses many different ways. So first I'll classify them by activity. There's for-profit and not-for-profit. Not-for-profit doesn't mean you don't make a profit. Not-for-profit just means how you distribute those profits. So in a not-for-profit, all the profits are distributed back into the company. It could be just in a cash account, it could be used to buy more buildings, equipment, inventory, etc., but it's automatically redistributed back into the company. Whereas a for-profit means that the owners of that business can take a slice for themselves. So if you're a for-profit company, you can say, I want to take this many dollars of the profit, just add it to my personal bank account. Done. My decision. Also, types of business by activity, there's merchandising, service, and manufacturing. Merchandising just means that you buy an inventory. You add value somehow, and then you sell it at a profit. Add value can be done a million different ways. It doesn't mean make some sort of material change to the product itself. It could just be packaging it some way. It could just be adding a ton of different items that people commonly buy in one store. That's adding value. It could be having employees that explain to customers or potential customers what the particular product does. A million ways to add value. So just be aware also that merchandising, add value is very vague. It could be a million different things. It's just buy an inventory, somehow add value, sell at a profit. Service is even more self-explanatory. Service just means that you're, as it sounds, performing some service for someone. Because financial service tends to be different than a lot of other service, some people split them up into two groups, financial service and all other services. I think that's sort of unnecessary, but just be aware that some people do that. And their argumentation behind that is hey, with financial services, most of the time it means it's involved with money. You're taking a loan of some sort or getting money somehow, and money is a tangible thing. So unlike other services like mowing a lawn, there's almost no tangible aspect to that. You're not receiving a tangible thing. Whereas with financial service, a lot of the time you do receive some tangible thing. So they make its own little subset or different type of business altogether. But again, I disagree with that because a lot of the time financial services can just be advising. Financial services can be offering IPOs, which is stocks. You know, a stock is not a tangible thing. So I just put them all under one group, service companies. And then there's manufacturing companies, which is the key word there is raw materials. We're buying raw materials, we're putting them together into a finished product. Now we'll go on to types of business by structure. This is legal definitions. Again, I'm here for accounting, so I'm not going to talk too much about the legal stuff. But the first two types are sole proprietorship and partnership. The only difference between those is in a partnership, there's more than one person, so two or more people. And that just means with sole proprietorships and partnerships, in the eyes of the law, there's no difference between the person, the owner, and the business itself. They're the same thing. So the business's activities are put on that person's personal tax form. The business is seen as the person. If the business is sued, the person is liable. So if the total assets of a company is $1 million, and then you get sued for $1.5 million and lose, they'll use the $1 million of the business, and then that other $500,000, they can go after you personally, your house, your stocks, your bonds, your car. So it's very risky. Whereas with a corporation, you're seen as a separate entity. The corporation is a separate entity from the person. There's limited liability, but there's a downside to that. As I said earlier, you are taxed in a sole proprietorship, and partnership is the same thing. A corporation is its own entity, which means it's taxed in its own right too. So in a corporation, first the corporation is taxed, and then the distribution to the owners is taxed. So we call that double taxation. So that's a downside. And then LLCs and LLPs, limited liability corporations, limited liability partnerships, those are just weird combinations of corporations in the first two groups. So a lot of the time it involves tax benefits with limited liabilities, meaning you don't personally get sued. But I won't go too far into that just because that's some more intermediate law topic. So, moving on, a corporation has stock. Now, technically, all businesses have stock. It's just how easy it is to buy and sell it. In a sole proprietorship or partnership or a private corporation, that business still has stock, still has ownership, but you need to actually, go up to that corporation or that group of people that own it and say, I would like to pay money and own part of your corporation, and they can say yes or no, yay or nay. Whereas a public corporation, what that means is that stock is sold on a market that anyone can buy. Anyone can buy or sell stock on if it's a public company, anyone can buy or sell it on a market. So that's all that means. It's just a public corporation has public shares of stock available on these markets, which makes it extra easy just to buy and sell and raise money, which is a really big advantage of a corporation also. Is it's really easy for a corporation, just because it's its own legal entity and the legal rights given to it, to raise a lot of money. And especially for public corporations, really easy to raise a lot of money. And as I said earlier, accountants, we try and think of profit as how do we just go through what we actually have done and what have we earned. But cash is still king. And at the end of the day, what's really important is if you have a lot of cash, you need that cash to keep your business running. You also, if you have a lot of cash, if you are at some type of disadvantage, having a lot of cash, you can buy whatever advantage the other competitor company has. So at the end of the day, I want to say, just as a caveat, as an accountant, you're thinking a lot about not cash as much, but just be aware, cash is important. Cash is king. It's a really big deal. And why companies go public, offer ownership in their companies, is because that is how important getting a large amount of cash can be. They're willing to sell their interest and their ownership just to get a lot of cash, because that makes them so much more competitive. So, sorry, I'm going to get off my soapbox right there and move on. Other ways to think about corporations, from the opposite party, from the investor's point of view, there's limited liability. Diversified portfolio is easy. If you can buy and sell small shares of different companies, you diversify your portfolio that way. You don't have to start and run and own an entire electric company, an entire car company. You can just buy stocks of each of them. And, dividends too. Which dividends is actually given a preferential tax treatment compared to other types of wages, paychecks, but it's still not as tax efficient as, say, a sole proprietorship. But, it's still something to consider. And over here I have dividends are not an expense or redistribution. That's an accounting aspect that I'll talk about later. But again, dividend just means you're taking what the company has and giving it back to the people who own that company. So therefore, we don't call it as much an expense. We say it's a redistribution. And I'll get more into that later. And then one final aspect about the structure of a business. There's a nice little vocabulary term we have here called financial leverage, which means if you want to get money for your business, there's two main ways to do it. There are two only ways to do it, actually. There's equity and debt. Debt means you go and you get a sum of money and there's a specific interest rate and then you pay it back, normally with interest. That's what debt is. Whereas equity means you get a sum of money and that person owns a portion of your business and you aren't actually, they are not entitled to anything though. So with debt, the person that you owe debt to, they're entitled to your payments. Equity, you don't have to pay them. Now, if you have profit and you have the ability to pay, say these dividends, that's going to be really important. There's going to be people who say, okay, pay the dividends. But at the end of the day, there are two ways, just two ways to finance, to capitalize a firm. And that's through debt and equity. So really important just term there. Now, moving on. So as I said earlier, now that we have a basic understanding of what business is and what it does, accounting is the language of business. And what I mean by that is businesses are really complicated things. They have thousands of transactions, ways to look at them. But investors, whether you be, someone who's offering debt or trying to buy equity in a company, investors don't have time to go through every single thing about a company. Imagine if you had to try and figure out every single thing about a huge company like Apple before investing in it. Walk to all of their distribution centers, try and figure out all of their management, look at every sale they've made. That'd be ridiculous. So what accounting does, and this is how I'm going to try and sort of teach accounting, and that is saying accounting means we look at a basic reoccurring thing about business, or sometimes it's not all basic, but a reoccurring aspect of business, and we say, how do we put a number to it, and how do we put a label on it, and how do we use those numbers and labels to make statements that represent an entire business in a simplistic way, or as simplistic as reasonable. So here I just have, some groups accounting to answer that question. How do we talk, language of business? How do we represent what a business is efficiently? We make accounting, and accounting has rules and standards. Now, in the United States of America, the rule book is called GAAP, Generally Accepted Accounting Principles, and that is made by a group called the Financial Accounting Standards Board, FASB. FASB is a private group. It's not government, and they make the rule book GAAP. Now, a lot of people go, wait, private group, why is it not a government group? The answer to that is after a while, people realize that all these political pressures and aspects of politics really can make an inefficient accounting system. And so the businesses themselves came together and they said, well, how about this? We'll make our own group to give us accounting rules, and we'll run it by the basic idea by the government, and the government will give it the okay. And the group that gives it the okay is called the SEC, the Securities and Exchange Commission, and they're sort of what gives the FASB their teeth. And what I mean by teeth is to say, since it's a private group issuing rules, what's to say one business says, well, you're a private group, you're not the government, we're not going to listen to you. The answer to that is the SEC will say, if you don't follow this private group's rules, we're going to cut all of your equity and your debt. You're not going to be able to issue bonds anymore, and you're not going to be able to issue stock anymore, and that will ruin a company. So that's what I mean by give a company teeth. And then just like there's the metric system and the English system, the United States way is the rest of the world's way, we have that with accounting too. The United States has GAAP, the rest of the world has International Financial Reporting Standards made by the International Accounting Standards Board. The difference between these groups are not nearly as profound as the metric system compared to the English system by any stretch of the imagination. A lot of them, they're the same. In fact, they've even worked together at points in time to try and make similar standards. So I won't go over IFRS as much in this tutorial, but it's definitely something to be aware of and read up on. And then, surprise third player, basically just in the past decade, even less than a decade ago, in 2007, I believe, after a round of financial scandals, the United States government said, okay, we need to shake things up a bit. So they made a law called Sarbanes-Oxley, known as SOX, that made a government entity that gets more tied in with the accounting standards and the accounting process, called the PCAOB, Public Company Accounting Oversight Board. There's a whole list of things that SOX does to companies and to the private group and the private sector. Since this is Intro to Accounting, I'm not going to go too heavy into that yet. Basically, all it does is it made a couple big rules as far as CEOs and CFOs need to sign their names on financial statements, and the PCAOB looks at how private companies audit other private companies, which is a whole process and a whole subject in of itself. So don't worry about this too much. And again, other players, I have the IRS. The IRS doesn't make financial accounting standards, but it does get involved with financial accounting later on, and that's more of an intermediate topic. But I just thought I'd mention it now, and it's how companies pay taxes. And then also the AICPA, American Institute of Certified Public Accountants, they make the CPA exam. And again, this is another weird crossover of a private group with government interest. If you are a CPA, if you pass those exams, then you have legal rights. You're allowed to sign an audit. And an audit, in case you didn't know, just means it's a requirement of public companies to be audited by an independent third-party group. So, if you're listed on a stock exchange, it is a law. You need to pay a group of accountants to come in and say, we looked at all their books and we think it's all right. That's called auditing. And it's a rule for public companies, and a lot of private companies do it too, because Even if it's not a law for you to do that, a lot of banks say we're not going to issue a loan unless we know your financial statements check out and you're going to have to be audited. So, like that's a huge industry in and of itself, and it's the AICPA who makes the exam to give you the legal right to sign an audit and say, yes, I'm an auditor and this is what I did. And there's other tax things with it too. I think it's sort of easier for you to be a tax preparer if you have a CPA. But enough about that. So back to the original question at hand. What is accounting? It's the language of business. And what does that mean? It means that we look at common business occurrences and we try and classify them in a way that makes it easy to relay this information about a business. And how do we do that? Well, accountants came up with an equation, a way to think about and classify business activities. And that equation is assets equal liabilities plus owner's equity, which is saying what you have, assets, is a combination of what you owe to someone else and what you own. So for example, let's say that I bought a pencil so I own it. And then let's say that I borrow a pencil from you and then I'm going to give it back to you later. I have two pencils. I owe you one and then I own one myself. That's the basic setup. What you have can be split into what you owe and what you own. And notice this equal sign. This means that assets always perfectly equal liabilities and equity. You can't have one side being bigger or smaller than the other. Now, when I said perfectly, just a little caveat to that. In the real world, businesses are so large and so complex, and accounting involves so many estimates and rounding issues that in reality, will it perfectly equal? Well, no, we're going to round it so it perfectly equals. But that's more like a real-life application. For an intro to accounting, this is what you need to know. Assets equal liabilities equal side. One side equals the other. And then we use this equation, and then we have these things called financial statements. And I'll get into that in my next tutorial video. But the financial statements are saying, let's take this accounting equation that kept track of all the things the business did, and let's sum them up into these broad categories. And let's use those broad categories and the numbers associated with them to make predefined statements that show aspects of the company. So there are financial statements, with different purposes. One financial statement, the income statement, says we really only want to look at the revenues and expenses and net income, the profit that happened with the corporation. So all the things related to revenues and expenses in the accounting equation, we're going to sum up and include, and we're going to make that an income statement. Whereas a balance sheet is saying, that's another type of financial statement that says, well, we want to really look at more along the lines of the long term. The income statement is just about the revenues and expenses for a certain period of time. Whereas the balance sheet is saying, well, let's look at a long-term, entire life of the company. What are the assets, liabilities, and equity totals? But we'll get into more of that later. But the basic process here, and this is how I'm going to teach the entire tutorial, is it's going to be, here's a business occurrence. How do we logically put this in to these categories with numbers? And then how do we take those categories and place them in these financial statements? That is pretty much all of accounting. So let's go into some specifics on how. Now, with this accounting and filling out the accounting equation, it's, here, I'm just going to erase this. We can start over from scratch. We say, everything is going to have an account and an amount that goes with it. Now, first little point I want to make is when you're filling out the accounting equation, you can see right here, assets. There's an amount, and then there's an account that goes with it. In the previous example, I just was simple and I wrote pencils, but there's a really good chance that, just based on what you're using it for, it's going to have an account name. Now, the good news for you guys is the accountants make these accounts very self-explanatory. Cash is called cash, inventory is called inventory. And instead of giving you an exhaustive list of all the accounts that are possible and what's in them, again, I'm just going to take the approach of showing, okay, here's an aspect, here's a thing that happened, how are we going to record it? And eventually you're going to see a logic point, oh, well, this makes sense. And again, the whole point of accounting is it's supposed to logically make sense. What you have is a combination of what you owe and what you own. So the whole thing about accounting is it's supposed to be logical and it's supposed to simplify things. Accounting itself can sometimes be pretty difficult, but if you understand the basic idea of why we're doing what we're doing and how we do it, filling out the accounting equation isn't that hard. Now, with that in mind, there's a couple basic ideas, assumptions, concerns, principles, rules that we have when filling out these accounting equations. First, as I mentioned earlier, we use accrual accounting, not cash. Now, accrual just means, this is a daunting word for a lot of people, but all this means is we care about the action. The economic substance is the vocabulary, not the cash. So what I mean by that is, let's say we have two different options, option A and option B. Two different events, event A and event B. In event A, I'm selling you pencils at $1 each, okay? In fact, let's just simplify it even more. I'm selling you a pencil, okay? And I'm selling you this pencil at $1. Now, in option A, I say, hey, how would you like to buy a pencil for $1? And then you say, okay, I'd love to, and I give you the pencil, and you say, I don't have the money right now, but can I pay it to you a month from now? And I know you, and I think you're a good customer, so I say, sure, yeah, you can pay me a month from now. Now that's what happens in option A. In option B, you say, as the customer, hey, I'm going to give you this $1 now, but I don't really want the pencil until at the end of the month. And I say, okay, sure. I take your cash, and now I owe you that pencil. I haven't given you the pencil. I haven't really sold anything. It's still in my inventory. So in accounting, we would say, which one has the sale? Well, it's option A. The economic substance is what we're doing here is selling pencils. So we recognize sales, and we recognize anything in accounting, not based off of when we receive cash, but when we actually, have significantly performed what we said we're performing. If we're recording sales, it's not going to be based off of the cash, it's going to be based off of what we actually, if we actually perform the sale. So again, accrual action. We care about action. And then from that, we have two different vocabulary words, accrual and deferral. Accrual means action first, dollars second. So in option A, we perform the action and we get the dollars later. That's an accrual. Option B, where the customer gave the money, but we don't actually perform the action until later, that's a deferral. Now, over here I have some other guiding assumptions and principles. One is the separate entity, which is saying the owner is different from the business. Now, I know you're saying, oh, just a couple minutes ago you were talking about, that sometimes they're the same thing. That's for legal purposes. For accounting purposes, the separate entity assumption means that the owners of the business are separate from the business itself. So if I own a business and then I go out and buy a Lamborghini for myself, lucky me, I would not include that Lamborghini on the company's assets. It's my personal thing for my personal life. Another thing is a monetary unit assumption. I sort of touched on that earlier when I said, there's always an amount. We record everything in, money. For the United States, it'll be dollars. We can't really, we don't record things that don't have a reasonably, a reasonable amount of money attached to them. Like, for example, say, and this creates a problem because, say, our business is the same as the other business right now, but our business has a lot better trained and a lot more helpful and a lot more efficient employees. Well, we can't list that as an asset because there's no way to monetize. There's no way to say, oh, our employees are worth this much money. So, everything needs to be broken into a monetary unit, and if it can't be, we don't record it. And again, there's actually a lot of controversy about that. But then the reply to that, the accountant's reply to that is, well, the business with better employees is going to eventually make better sales. So everything that we can't capture with the monetary unit assumption will be captured in some form of the business, later, say sales or growth or something like that. But anyway, moving on, the time period assumption just means we can break things up into useful time periods. This is more of a financial statement thing. We'll show in financial statements, this was the net income for a couple of months or a year or something like that. This is only saying it's useful to do that. And going concern means that we're going to make accounting standards and principles, and we're going to record things, assuming the company is going to exist in the future, which is actually a pretty big thing when we get into later on. But for now, just remember, going concern means we're going to assume this company will last into the future indefinitely. And some principles is there's the historical cost principle. This is really big for a practical application. When you buy something, you record it at what you bought it at. And years later, you're still going to keep it on the accounting equation and in your financial statements as the historical cost you bought it at. So if you bought land 1 year ago and you bought it for $1,000, and then in 1 year currently, in 1 year it's worth $2,000. Your assets on your financial statements, your accounting equation, is going to show that at the historical cost you bought it at always. $1,000. Doesn't matter what the fair market value is. Now, just a little aside, accounting is trying to break into some more fair market value aspects, but it's a very slow transition, and we're still very, very interested in keeping the historical cost principle. Just because it's very conservative. Because, say something along the lines of, if we bought that land for $1,000 and then next year it's worth $2,000 and next year it's worth $1,500, do we want to show all those gains and losses, and do we want to have our financial statements radically changing each year if it's really not useful to us, if we're really just using that land over and over again each year and we don't care what its fair market value is? That's a big question. And it's one that's not perfectly answered. Also, there's a principle called the revenue recognition. That's what I was talking about over here with accruals. We care about the action, so we're going to recognize revenue when we perform the action, not when we get the cash. Very similar, we have the matching principle, which means we're going to match revenues and expenses. If there's an expense related to what the revenue we recognize, that's when we're going to recognize the expense. So let's say that, for example, a good example with that is, say we bought inventory to sell. Now, if we bought inventory, we paid cash, but we're not going to expense it and say, okay, well, we bought something, cash going out. No. We're going to what's called capitalize it. We're going to list it as an asset, and inventory is an asset. And then when we actually make the sale of that inventory, that's when we're going to expense away. That is when we're going to expense away how much we bought that inventory for. So matching just means if there's an expense related to revenue, we're not going to recognize that expense until we recognize the revenue. And then this last one, full disclosure. That is pretty much just saying if it's useful in making a decision, we're going to disclose it as accountants. Now, at this point in the video, I'm sure you're wondering, like, whoa, this is a lot of moving parts all at once. I have to make sure everything has a monetary value, keep the business owner separate, and these time periods and historical costs. Don't worry. Again, I just wanted to throw a lot at you, and we're going to reinforce all of these things through example after example. I'm going to say this is a business thing that happened, and here's how we're going to record it, and I'm going to constantly fall back and explain this is why we recorded it the way we did, using these assumptions and principles and using accrual accounting. So I know it seems like a lot now, but as we go through and as I say, here's the action that happened, here's how we record it, and here's why we record it, I'll constantly fall back on these assumptions and principles, and I'll constantly be explaining, this is logically why. And a huge, huge aspect of accounting is if you just try and memorize everything, and just memorize and memorize, there'll be too much to memorize. And you have to ask why and understand why, because if you understand the logic behind accounting, that's when accounting becomes easy. That's when accounting becomes, call me lame, but enjoyable. So, I understand we're already pretty far into a video already, so I'm just going to give you a little taste of, a basic example of a business. And just starting example, and again throughout the whole tutorial I'm just going to teach by example. So we'll start a little bit now because I want to get your feet wet a little bit. So here's the situation. We perform a service worth $1,000. In fact, I'm just going to say perform a service that we charge $1,000 for. The customer will pay us later. So that's the situation. That's the action. We perform something, a service, that we're going to charge $1,000 for, but the customer will pay us later. So this is going to be the beginning of getting your accounting toolbox ready and taking information and turning it into this accounting equation. And then later on in next video, I'll show you how to take aspects of this accounting equation and put them into financial statements. So, first situation, well, let's think about this. And in fact, if you want to pause the video and think, how would we record this? Just think about it right now. Pause the video. Okay, so now here's what we're going to do. This is the correct answer. First, we need amounts. Well, the amount is given to us. It's $1,000. Now, everything has to be categorized into assets, liabilities, and equity. So, here's the basic situation. We got $1,000 of an asset. Now, what's the asset? It's not cash, but accounts receivable. Accounts receivable is just a term that accountants came up with to say, hey, we don't receive the cash yet, but we have cash coming to us. And that's what accounts receivable is. Again, all these accounts are very self-explanatory. And why do we call it accounts receivable? Well, because, it's full disclosure. We don't want to say we received cash for it, but it's also revenue recognition because, we performed something. Now we're going to recognize, all the aspects of that revenue. And then over here, an equity, it's equity because we service revenue. So, big deal here. So, we have $1,000, that's the amount, the monetary unit. We performed a service that we're going to get revenue for, so we recognize that it is revenue, so we recognize it on performance, service revenue, and then we received sort of like an IOU, so we don't call it cash, but we call it accounts receivable. So that's sort of a good first example of using all of these assumptions and assumptions and principles right here to record, okay, we got $1,000 monetary unit. These are the accounts, again, very self-explanatory. And again, at the end of the day, assets equal liabilities and equity. One side equals the other. Perfection. Also down here, I have this little note saying, there's these entries and then there's adjusting entries. So, for example, an adjusting entry to this would be, original entry means when the action is performed, and adjusting entry means we get more information. So then over here, adjustment, more info, Now the customer paid us. So the adjusting entry on the additional information of the customer paid us, well, what's happening? Well, first we're receiving the cash, so that's really good. So we receive the cash. Now the accounting equation has to balance. Well, what's balancing? Oh, well, our 1,000. Oh, not that. Our $1,000 of accounts receivable is going down. You know, this is called an asset swap. We're swapping one type of asset for another. You know, we used to have the asset of an IOU. Someone owes us $1,000 of cash, but then we took it away because they actually paid us the cash. So that's called an adjusting entry. Now again, you know, pretty much in 40 minutes, I've explained to you like what the first week of an accounting class would be. So don't worry if it's a lot of information for you. But again, just as we go through these examples, I'm just going to constantly show you, here's how these assumptions and principles are enforced. This is why. And logically, again, you know, we performed the action, so logically speaking, we should recognize revenue. So we did. We recognized revenue at the monetary unit that it's worth. And then at the same time, that IOU that we have, again, we have it. It's an asset. So we need to record that asset. Not as cash, but as the accounts receivable, which is just what we came up with. And when I say we, I mean accountants came up with to show this is how much money that we should have coming in. And then adjusting, when we actually received it, again, we want to show what the company is actually like, so we decrease the accounts receivable, increase the cash, because we actually got the cash. So that's pretty much a pretty comprehensive introduction to accounting. And again, all accounting is from here on out just looking at these different situations and saying, okay, logically looking at all of these, you know, logic points and principles and assumptions, and using accrual accounting, how do we put this situation into an equation? And then how do we move those equations, the aspects of the equation, into financial statements that people know how to read? So, I just want to leave you guys with some final notes. Again, don't memorize. Use logic. Think about what's the substance of what's happening and how we can record it. Then, you know, we'll get into this later classes. You know, I don't want to get into it right now as much. I already threw a lot at you. And then also, final note, make sure you get an old accounting book with an old solution guide or study guide. Accounting does change and principles change, but for intro, not too much. And if it has changed, I'll make sure I tell you. You know, don't worry about it. And then also, I mentioned at the beginning of the video, I'm going to explain debits and credits, so I'll do that right now. Debit means left, credit means right. And again, if you're going to stick with me through these tutorials, and you know, you're following a new type of learning accounting, the one that I'm proposing, don't worry about this right now. But if you really need to know debits and credits, here's what it is. Debits means left, credit means right. Left side of the equation, right side of the equation. So if something's on the left side of the equation, it's debits to increase, credits to decrease. If it's on the right side of the equation, credits to increase, debits to decrease. It just switches. So with assets, if you're saying an asset is increasing, you're going to say, well, we're debiting it. And then with owner's equity, you know, if owner's equity is increasing, we credit it. So this is a debit of, you know, a debit of accounts receivable, a credit of service revenue. Now down here, when we're subtracting accounts receivable, you know, we're debiting cash, increasing cash, accounts receivable going, so we're crediting accounts receivable because it's going down. And contrariwise over here, a lot of the times expenses are seen, now this is the tricky aspect of debits and credits. Expenses are, you know, negatives. So let's say, yeah, I'm just making this up. Let's say we have a $400 expense. And over here, we're paying for it in cash. You know, so we're decreasing our cash to pay for this $400 expense. Decreasing over here is okay, cash is an asset, the asset is going down, left side going down means it's a credit. Credits to decrease. So it's crediting cash, $400. Now over here, as you can see, we're going to call this a debit because, you know, it's decreasing owner's equity. So this is a debit expenses. So as you can see over here, you know, another way to think about it, assets, expenses, and dividends are debits to increase, credits to decrease, opposite for everything else. Now that's just if you need to know debits and credits, and that's, again, a really complicated terminology in and of itself. So, to wrap up, I threw a lot at you today, but if you get nothing else, just remember, accounting has logic points, and we reinforce those by making decisions on how we record things in the accounting equation. And we're just going to reinforce those principles and assumptions again and again by saying, here's what happened, here's how we record it. And eventually we're going to take all that we record and put it in what's called a financial statement, and I'll get into the specifics of that later. So, I know this was quite a video. I hope I didn't turn anyone off from accounting. Again, if you stick with it and really study it, I think it's actually quite enjoyable. So I hope you guys had a great time, and I'll see you in the next video.